So the whole life policy is kind of boring in a sense. If you're looking for an investment, something that's going to grow with the markets, then whole life may not be the place for you. Now, going back to the late 1970s and early 1980s, people started to become very aware of this. And in the early 1980s, actually, there were some fantastic opportunities in the stock market or in the equity markets, which you'll have read about in Module 6. In response to that, we see the introduction of a new product that's going to give people the opportunity to invest in a permanent insurance policy, that is, one that's going to stay with you for your whole life without running out at some point. However, this new product also allowed some flexibility, some variability in these investments. I know some of you already know what I'm talking about. The product in question, of course, is Universal Life. And Universal Life is designed with either a level premium, or we can have Universal Life with a premium that looks something like this, which we call a yearly renewable term, or YRT, cost of insurance, or it can have this level cost of insurance as I've illustrated on the board. Level, or sometimes we refer to that as a term to 100 or T to 100 cost of insurance. Now, what happens with Universal Life, yes, we have this cost of insurance associated with it, and there is a death benefit associated with your Universal Life policy. But in addition to that, the policy owner has the opportunity to decide that they would like to put extra money into their Universal Life insurance policy, whichever type of funding structure they've chosen, whether they've chosen a YRT or a level funding structure. They say, that's the premium structure I've chosen. I want to put in a little bit more money, that is, to fund what we call the account value or the cash value or the accumulation fund or the accumulated value or the cash surrender value. It goes by a number of different terms depending on which insurance company's literature we use. Whatever we happen to call that, what's happening now is the client is actually contributing the money to build that account value. The account value in a Universal Life policy is a little bit different than the policy reserve in a whole life policy. Remember that in a whole life policy, we said the insurance company really owns this policy reserve. They control it. Well, with a Universal Life policy, the client now has the opportunity to control this investment. And there are a number of investment opportunities within Universal Life policies. You'll find mutual funds, savings accounts, indexed accounts, GIC type of investments. Almost any pooled investment that you would find sold commonly, you could find represented in a Universal Life account value. So this Universal Life account value then, not really designed to pay the death benefit later on. Instead, what it's designed to do is to give the consumer, the policy owner, the opportunity to maybe pay their premiums later on in life. Now, in some Universal Life structures, the account value will form part of the death benefit. In some Universal Life structures, we might access the account value later on as a policy loan, or we might collateralize it and borrow against it, or we might just use it to pay our premiums. So there is a variety of different options available with Universal Life. And when we look at Universal Life in more detail in a future video, we will see that it is quite a complex product. There's a lot to understand about Universal Life. When the insurers introduced this product, they really wanted to introduce a product that was going to offer all kinds of flexibility in order to attract new policy owners. That flexibility is wonderful, but with that flexibility comes some complexity as well. Now, there's one other product that I'm going to put on the whiteboard. It's a product that I don't want to neglect, but it doesn't get a lot of attention in your material, really. It's what we call a term to 100 life insurance policy. Now, a few minutes ago, I said in a Universal Life policy, when we talk about level cost of insurance, we sometimes refer to that as term to 100 cost of insurance. Term to 100 also refers to a very specific type of life insurance policy. This is almost like going back to whole life policies in the days before we made this policy reserve available to the client. In a term to 100 policy, you're going to pay a level cost of insurance for as long as you own the policy. It's a permanent insurance policy. Even though it's called term, like we saw earlier, it is really permanent insurance. And because it's permanent insurance, you know it's going to stick with you throughout your life. The difference with term to 100 is that you don't typically have a policy reserve, although some T to 100 policies do generate a policy reserve after a number of years. But it's best to think of it as having no policy reserve or no account value or no cash value or no cash surrender value. That is, it takes away all of those features that we build into whole life or universal life policies to make those attractive investments. So with this term to 100 then, you're just paying exactly for your cost of insurance. Even though the name says term, it is a permanent insurance policy, and it will, in most cases, stick with you as long as you live. There were some older term to 100 policies that were designed to endow or pay their death benefit if somebody lived to age 100, or sometimes 96, depending on the insurer. But those term to 100 policies really aren't sold anymore because that's going to create a taxable disposition of that life insurance policy, which is not necessarily favorable for the policy owner. We're going to then go through each of these products, term insurance, whole life insurance, universal life insurance, in videos to follow. I'd like you to just think back to this initial structure. Remember that we're going to have these policy reserves or account values with certain types of policies. Think about how we're structuring cost of insurance as we go through each of the products. I'd like to remind you as well a couple features of life insurance that are worth considering. The growth that happens within the policy reserve or the account value can be accessed in a number of ways by the policy owner. It can be accessed in the form of a surrender. That is, you can actually just leave the policy and take these funds with you. It can be accessed in the form of a policy loan. So you can borrow against those values. These also form excellent collateral. So if you were to go to a bank and try to borrow funds, you would find that a banker would be, in most cases, happy to allow you to use this as a degree of collateral for borrowing purposes. Also, the growth that happens within this policy reserve or account value is, in almost all cases, tax deferred. We're going to talk later on about something called the exemption test, which mostly universal life insurance policies are concerned with, just as far as making sure that we're not treating this thing more like an investment than an insurance policy. As long as we treat these like life insurance, though, any growth that happens within the policy reserve or within the account value happens on a tax-exempt basis. If you have questions as you're going through the material, as I've mentioned before, feel free to ask. I hope for the time being this provides a good summary of these basic types of life insurance. I hope that you're understanding as we're going through, and if not, like I said, feel free to ask us some questions. Have a great day. Enjoy your studies. Thank you very much.